Gold just hit $5.0 while dollar crashed. The historic shift nobody saw coming timeline during 2025. Global markets crossed a psychological line that many economists once dismissed as impossible. Gold surged past $5,000 per ounce, while the US dollar suffered its sharpest multi-year decline since the early 1970s. Central banks didn't panic, governments didn't apologize, but quietly, something fundamental changed. During 2025, the world's reserve currency lost purchasing power at a speed not seen in decades. During 268 AD, the Roman Empire made the exact same decision, expanding money supply to fund growing obligations. Within a single generation, the currency collapsed, and imperial power fractured. Consider the question that matters most. How did we arrive at this exact moment? And more importantly, why does history suggest this outcome was predictable? History has witnessed this precise sequence before, again, and again, and again. Here is what is remarkable. Every major monetary collapse begins not with chaos but with policy decisions that appear rational at the time. Debt expands, currency weakens, hard assets rise quietly. Then suddenly, confidence breaks. Emphasis: this isn't speculation. This is over 2,000 years of documented monetary history. Tonight's story is not about gold alone. It's about why gold always rises when trust in currency declines, and why most people won't recognize this shift until it is written into future history books. Let's begin in 117 AD, when Rome controlled over 5 million square kilometers, stretching from Britain to the Middle East. This was the peak of imperial dominance. Trade flourished, taxes flowed, confidence was absolute. But by 268 AD, Rome faced a fiscal problem familiar to modern governments: military overextension, rising welfare obligations, and declining productivity. The solution seemed simple. Roman emperors began debasement of the denarius. In 64 AD, silver content stood at over 90%. By 200 AD, it fell to 50%. By 268 AD, silver content collapsed to less than 5% according to historian Edward Gibbon. The denarius became a shadow of its former self, and confidence vanished before the metal did. The math was unforgiving. Prices rose by over 1,000% in less than 50 years. Soldiers demanded payment in goods. Taxes were enforced in grain. Trade collapsed. From peak dominance to systemic breakdown took roughly 150 years. Remember this sequence. Now, 1,400 years later, Spain faced a similar crossroads. In 1580, Spain controlled the world's largest empire and access to unprecedented wealth from the Americas. Silver shipments from Potosi increased European money supply by over 300% within decades. Initially, prosperity exploded, but inflation followed. Prices in Spain rose 400% between 1500 and 1650. Government debt quadrupled. Spain declared bankruptcy 6 times between 1557 and 1647, according to economic historian Earl Hamilton. Silver did not create wealth, it diluted it. Unlike Rome, Spain collapsed faster, roughly 80 years from peak dominance to imperial decline. Now the modern era. In 1919, Germany emerged from World War I with crushing reparations. Government spending exceeded revenues by over 400%. The response? Currency expansion. In 1921, $1 equaled 75 marks. By 1923, it equaled 4.2 trillion marks. Notice the sequence. Phase 1. Fiscal stress emerges. Phase 2. Currency supply expands to cover obligations. Phase 3. Confidence collapses. Hard assets surge. This isn't coincidence. This is economic certainty backed by over 2,000 years of evidence. History doesn't repeat, but it rhymes with precision. So how does this connect to 2025? Let's compare metrics. Debt to GDP before monetary crisis. Rome, approximately 70%. Spain, approximately 90%. Weimar Germany, approximately 160%. United States 2025. Emphasis over 130%. Currency expansion timeline. Rome, gradual over 150 years. Spain, compressed into 80 years. Germany, collapsed in 4 years. Modern era, largest expansion occurred in just 15 years according to the Federal Reserve. Over $9 trillion was added to the balance sheet between 2008 and 2023. Gold reacted exactly as history predicts. $2,280 2011, $19 million 2020, $2,050 2025. Emphasis $5.0. If we position the modern system on the historical collapse timeline, We are currently at stage 2 moving into stage 3. Consider the mirror events. Rapid interest rate hikes. Rome raised taxes aggressively rising. Trade settlement in gold and local currencies. Spain lost silver monopoly. Central banks becoming net gold buyers. Over 1,100 tons in 2023. The highest since 1950 according to the World Gold Council. Central banks are preparing for a monetary environment where confidence must be collateralized. Remember the unanswered question from the beginning: why did this happen now? Because every system reaches a point where confidence costs more than currency creation can sustain. This isn't theory. This is 2,000 years of monetary history. History reveals 3 possible outcomes. Path 1. Rare stabilization, 10% structural reform, fiscal discipline, and restored confidence. Only a handful of nations like post-war Germany after 1948 achieved this. Path 2. Managed decline, 70% currency weakens gradually. Living standards erode. Gold and real assets retain value. This is the most common historical outcome. Path 3. Disorderly reset, 20% rapid confidence collapse. Forced restructuring and monetary replacement. Rome, Weimar Germany, Venezuela in 2018. Most observers won't recognize this pattern until phase 3 becomes irreversible. But you are not most observers. You now understand what over 90% of people will miss until it appears in retrospective analysis. No predictions, no financial advice, only pattern recognition. If we understand the historical precedent, the next phase becomes predictable.